I mean, some of the most exciting things that we find really are opportunities that the market has missed. They're not very glamorous, they're not sort of high-profile activism, they're nothing too clever. It's literally turning over lots of stones and finding very, very cheap companies that are still of very good quality. We're just buying them at incredibly cheap prices with a clear path to get that cheapness out. And I think this example here, Staude European Real Estate Finance, is a tremendous example of that. We've actually owned Staude or SWEF twice in GVF's life, and both times they've been very large investments in the fund, and both times, touch wood, they've been very successful. Just to explain what it is, so Staude is an investment company, a bit like GVF itself. It's listed on the London Stock Exchange, and what it owns is a portfolio of European real estate debt. So it doesn't own stocks, it owns the debt, and it's run by one of the largest real estate specialty groups in the world, a group called Staude. They run they run $100 billion. So I think they're probably the largest or one of the largest real estate investors in the world. They've got an incredibly strong team, and they go and find these really interesting loans that they can underwrite to property companies, people doing refurbishments, or companies that just need some debt. And they underwrite them in a way that banks can't. They're very specialist loans, and because they've found this niche, they earn a very interesting interest rate, a much higher interest rate than perhaps you might normally expect, on loans that are generally very well covered. And you can see it's actually it was a very successful model. You can see on the bottom right chart there, in the navy, the share price of SWEF on the London Stock Exchange, and in the grey, the value of that loan portfolio through time. And you can see for a very long time, the share price actually traded at a premium to the loan portfolio, which is a function of a high caliber manager, a really interesting loan book that paid a high and consistent yield, and a great underwriting process that saw no defaults over a 10-year period. That obviously changed during COVID, and COVID really took a hammer to the real estate industry in general. Even today, there's lots of office blocks sitting empty, lots of high street shops that are sitting closed, which is very sad. And obviously coming into COVID, thematically, there was lots of reasons to be worried about anything to do with real estate. The problem with those kind of big picture views, though, is that it lends itself to kind of missing what's nuanced and important and the detail about every situation, and that's what happened during COVID. You can see the navy, the share price sold off enormously just through generic real estate fear. That's when we turned up. The team and I did months of due diligence on the loan portfolio, got to know it really, really well, got very comfortable that the loans were actually okay, despite all the scary headlines. And we're really impressed with what Staude did at a sort of a loan-by-loan basis to protect their portfolio. A great example, I think the largest loan, or one of the largest loans in their book, was a loan to a hotel in Dublin. And obviously, hotels were decimated during COVID. No one's travelling, no one's booking rooms. And the main thing with a hotel is you've just got to keep occupancy up. That keep the lights on, pays the interest bills, keep staff employed. What they did, which I think was a tremendously clever idea, they sat down with the Irish government and said, look, you've got pandemic workers working all kind of crazy shift hours all over the country. They need somewhere to sleep every night. We have a hotel that's sitting empty, and they struck a bespoke deal with the Irish government, which meant that pandemic workers could use that hotel all throughout the pandemic. They didn't get the highest nightly room rate, but they had 100% occupancy. And even the best hotels and the best conditions never get 100% occupancy. So it guaranteed this fantastic cash flow stream all throughout the process. Meant interest payments were paid all the way through, none of the loans defaulted, and staff were obviously kept on. So on a case-by-case basis, they'd gone through the portfolio and come up with clever solutions like that. GVF, in all the kind of fear that was going on, GVF had managed to buy the loan portfolio at 80 cents in the dollar, huge discount. And a couple of years later, when there were no defaults on the portfolio and we'd received a lot of coupon income, the share price re-rated enormously, and it was a very successful investment for us, and we exited at that time. It's come interesting again, and sorry, this was really the point I wanted to make. Today, it's a very different proposition. We're not in COVID, there's no kind of big picture concern about the loan portfolio. The loans continue to perform very well. I still don't think there's been any defaults at all. But the company has gone into runoff, to liquidation. There's no nefarious reasons. This is a tiny little company. Staude manage $100 billion. So they've just decided they don't want to run this vehicle anymore. And essentially, as the loans mature naturally, the capital is repaid to shareholders, and at the end of that process, the company will be put into liquidation. What we love about situations like this, what we go and look for all around the world, is often in these kind of small, illiquid names where people have kind of stopped paying attention to them, the price can get really, really cheap. And I think that's a function of the managers not out there marketing anymore. No one's really that excited about the company. And the share price drifted, and we're essentially able to build a very large position for GVF, for our investors. Again. I think it has been the second largest investment in the fund for most of the last year. At this time at about a 15% discount. So we're buying that loan portfolio at 85 cents in the dollar. And we obviously know the loan portfolio very well from our first investment during COVID. And one of the things that we really liked about it was it has a floating rate loan book. So what that means is as interest rates go up, the interest rate you receive as an investor goes up with it. Interest rates across the UK and Europe have gone up enormously since we owned it during COVID, and we've also bought that loan book at a big discount. So combined, I think the running yield that we're receiving as a GVF investor is over 10% today. So we're getting a huge coupon just to sit there. On top of that, we've bought the loan book really cheap at 85 cents in the dollar. So every time the loans mature, we get the money back and we take a big uplift. We've bought $1 for 85 cents, we get $1 back. In the year that we've owned it, we've had 30% of the loan capital back. We've taken a big uplift in the fund each time. And if we add on top the dividends we've received, I think we've had over 50 cents in the dollar since we started buying this. And we believe there's a hell of a lot more than 50 cents in the dollar still to come. What we really like about investments like this is, like in our assessment, we think we'll probably make a 40% return over the life of the investment. We'll make that return over 3 or 4 years. So it'll annualise at sort of a mid-teens kind of number. Tremendously exciting return figure, but I think the thing that we're as excited about is the risk profile. The underlying risk here is not FANG stocks or high-risk technology stocks. It's a loan portfolio with a loan-to-equity value, a loan-to-debt value of 60% across the entire book, where there still haven't been any real defaults across the portfolio, and now a vehicle that's been run for 20 years. And it's a much lower risk proposition than, say, investing into the share market. Obviously, it's not risk-free, but for the return that we're getting, if you remember Emma's skew chart before, we think these kind of propositions are fantastically exciting.